Hey, good morning. Whoops. Good morning, guys. How are you? Hey, Zora. Nice to see you. Welcome back. Where you guys been? Hey, Erla. Nice to have you. Good morning and welcome, guys. What is today? Today's the 26th, Tuesday. The 26th. Ready to rock it. Missed you guys. Guys, we're going to do it like we always do it. And let me go ahead and throw the disclaimer out there right now. There is no doubt in my mind that there was a lot of great stuff that happened when John Novak taught. And if you guys need any clarification, if you want to talk about it, if you want to present your charts trying to do what he did, please feel free to drop them in the room. We'll talk about them when we talk about charts. I did put his NASDAQ futures trading plan in the room for you because I want to make sure that if we are following up a John Novak class, we've got John Novak tools. But we're going to do what I do each and every morning is we're going to talk about news, guys. Good morning, Nanda. We're going to talk about high impact, medium impact, and the way they impact trading. So every morning I come to forexfactory.com and I start looking and I make sure that I don't see that orange or red box. Just to let you in on a little secret here. When I'm looking at news, that's it. That's all that I look at. I don't look at what the news is. I don't ask what they're talking about or anything like that. Honestly, the only thing that I'm concerned about is whether it is medium or high impact. And then I choose to stay out of the way on either one because what happens is when those news releases come out, very often the market becomes erratic. It can jump and spike and bump, and I just don't want to be in the middle of that. Oops, sorry, I keep messing with stuff. All my monitors got messed up when I relocated. So we're going to do this every morning. This is part of my routine. I wake up, I have a cup of coffee, I get my charts going, I check news. And then when we're talking about everything presented in this classroom, more importantly in the first hour, because the first hour is the same hour every day, if you go to the trading guide, you're going to see exactly what I'm going to talk about. And I'm going to go to the common terms section, and I'm going to scroll down, close your eyes. There we go. And we're going to talk about a high probability trade today, guys. I did it last time I taught. I'll do it for the next probably 10 years. The high probability trade, guys, is when each indicator on every chart agrees for the trade, for the rules for the trade. All the triggers are their strongest. No termination conditions exist. There's no trouble spots between your entry and your target. Guys, this is the best of the best. This is the highest probability. This is the trade that typically wins 70 to 80% of the time when you follow the rules. My goodness. This is a trade that success level creates a lot of confidence. But the most important thing is, guys, this isn't your get-rich trade. This isn't your only trade. This trade sets up, hey, good morning, Luciano. This is a trade that really sets up maybe 3 or 4 times a day. But what it does for you, once you understand the very basic concepts of this trade, is it teaches you to read your charts. You're going to understand what your indicators are telling you, guys. So when you look for this high probability trend trade, you're not necessarily saying, oh man, this is it. You're learning how to understand what your indicators are telling you. You're beginning to learn to recognize advantages, and then you're going to turn those advantages into trades beyond the high probability trend trade. But once you learn to read your charts, you're going to realize that 90% of your day is chart reading. 90% of your day is doing nothing. Really sitting on your hands, waiting for advantages. 10% of your day tends to be the trading when those advantages are present. And once you're solid with your chart reading, and guys, I'm going to give you everything you need to get there quick, you're going to understand where the market is likely to continue. This becomes your entry for the highest probability trend trade, and ultimately the other trades that follow. You're going to understand where the market is likely to go, and this is going to help you with profit targets, and you're going to understand where the market is likely to stop, and that's what we call a termination condition. And those just pretty much can ruin forward progress of the market. So we're going to keep it real simple this morning, and we're going to talk about only 3 rules. And I want you to not only learn the rules, right? Oh, rule number 1 is strong trigger lines. I want you to really attach that word to what it means to have strong trigger lines, guys. And that's the advantage of momentum. And momentum pushes a market, and it can break areas, and it can cover mistakes, guys. And momentum is an outstanding advantage, and it's the first one that we look for. Once you have it, you'll go to rule number 2, and not having any of those termination conditions, none of those likely to stop the market areas, that's going to give you a clear path, and a clear path gets you room to your profit targets, guys. And momentum and clear path. Once you understand these 2 concepts, once you trust in these 2 concepts, it opens a million doors for you. And that's what's going to set you up to find your next trade, your second trade, your third trade. And then rule number 3 is specific to the high probability trend trade, and this is just defining your entry area. So these 3 rules are going to come to be on only 2 charts. Hey, good morning, Rob. And I love the phrase, the large chart leads the way. The large chart tells you to look for an entry. The large chart tells you that you have enough advantages to have a trade. And the large chart, on the most current bar, the first bar on the large chart, will define the direction, the momentum, and the areas that you're using in the market. Rule number 1 defines the momentum. Rule number 2 gives you that clear path. And these 2 rules are met on the large chart. And one of the safeguards you could give yourself is simply don't look to the small chart until the large chart says that your rules are met. And what that does is it keeps you from getting lured into the smaller, faster chart, because the large chart is a slow moving. It's a very broad stroke of a brush. And it shows the overall opinion of the market, and it gives you 66% of your advantages. Once the advantages are in play, you're going to go to that smaller chart, and that smaller chart's a fast chart. It's a refinement chart. On your small chart, you're going to see 20 to 30 bars worth of movement that on the large chart is contained in that most current bar. So the large chart's difficult to see change, but the small chart lets you refine it to break it down to pinpoint where the market is most likely to continue. And by using this little 2-chart combo, you're going to be able to reduce your risk, which is always a wonderful thing, but it's also going to increase your profit potential. And rule number 3 comes on that smaller, faster chart. Nexgen has set this up for you like that because you can begin to ask yourself, who am I trading with? Who am I trading against, guys? And trading with the large chart, with the large crowd. These are the people that can move the market, that create trends and momentum, that react to key areas. And the large chart just leads the way. It says, hey, we're going up fast, and there's nothing in the way. Come on and join me. And then your small chart is this small crowd. And guys, this is just an analogy. There's not people in a parking lot. But the small crowd fights, and that's what they do. They fight the large crowd. If the large crowd says up, these guys kind of gather their resources and try to push it down. And the small crowd fails 70 to 80% of the time. Your rule number 3 for entry on that small chart, guys, it's going to pinpoint where the small crowd's most likely to fail. And we're going to do that with crazy precision. And that's kind of what we're going to do this morning. We're going to talk about 2 charts and 3 rules. We're going to learn the trigger line and Fibonacci rules for when it's okay to trade. Hey, good morning, Morgan. Thank you. Nice to be back. You know you like your job when you miss it after 2 or 3 days. You guys can simulate, especially you newer guys and gals. One of the great things about the demo and being on the software is that there's a simulator, and the simulator is like the driving range or shooting free throws or the batting cages. It's a no-risk environment. It's just where you're going to get better. Don't be afraid to be on simulator. Don't be afraid to take practice swings every now and then. But the first step in becoming a confident trader ASAP is make sure that everything that you do on simulator, drop it in the room, guys. Tell me what you saw. I encourage you to tell me what your chart read is, to always go back to those 3 advantages: momentum, clear path, and entry. and describe them. Point them out on your chart. Tell me what your chart read is. And then if your chart reading needs any adjustments, we can do it right then in the moment. And you'll find that, and you'll probably see it in the room, the people that post the most tend to get to where they want to be the fastest, because we all make mistakes. And that's just one of the wonderful things about being human, is we make mistakes. And when we're learning something new, we might make mistakes often. And if you give me the opportunity to give you feedback by posting in the room, guys, we can not only identify any challenges that you're having, but we'll work together and make sure that you overcome it sooner than later. So don't be afraid to post in the room. Make sure you're telling me what you see. And then we're going to simplify. Oh, gosh. I need a t-shirt that says keep it simple. Because the less you look for in the beginning, the fewer trades you try to find, the more focused you are on having advantages rather than entering the market. Guys, that simplicity really does pay dividends. But you've got to know what looks you're going to commit to. And you've got to learn those looks so that they become easy. And that comes through repetition, guys. And that's the second piece to getting to where you want to be as soon as possible, is use the spreadsheet that Nexgen gave you when you downloaded software. It's the same spreadsheet that I drop in this room every day, guys. And there's 5 tabs. 4 of them are for you. The first tab is a trade journal. So every time you take a trade, drop it in there. Talk about what you saw, whether you won or lost. It's Dear Diary. Today I took a long trade. It was awesome. Perfect entry. I want to make sure that I don't miss that. You're going to get feedback on everything that you post in the room. If you take a second to type that feedback into the notes section, that's going to help you when you use the spreadsheet the way it's intended, guys. Every morning, you should come back and look at what you did yesterday. It's hard if you had a rough day. It really is, because you're like, oh, I don't want to look at that. But when you look at what you did yesterday, it's going to set you up for today, guys. You're going to be able to look at the things that were bringing you success, and you can really commit to repeating them. And then you're going to look at the things that were taking that success away from you, and you can commit to avoidance. And you'll find that there are patterns and scenarios that feel easy, and you're very relaxed, and you don't fidget. And then there's the same patterns that feel forced, and it feels like you're working harder than you need to. And typically that's when you're breaking your rules, guys. But if you do this every morning, if you go back and look at those 5-10 trades, it'll take you 3 or 4 minutes. You'll begin to see these common threads, guys, and it really will set you up for the day and accelerate the learning. Over here, there's links on how to paste those pictures into the spreadsheet, and then even a picture of how to annotate to get the best feedback in class. And this is just, I'm repeating here, it's got to be 3 rules that you're writing down on your chart, guys. Momentum, path, and entry. Show me from start to finish. A lot of people love to show me their entry, but they don't show me where they got out. Whether it was a stop out or whether it was profits, guys, allowing me to see what you did from start to finish, it gives me the ability to not only help you with your chart reads on the large chart, but to help you refine to get the best entry on the small chart. And then we can start working on a management plan together to make sure that you're getting the most out of these trades. So where am I here? I lost there it is. That's your path. That's your plan. Is use the spreadsheet. The next tab is the 101. There's only 3 rules. On the spreadsheet, each rule is in green. Know what it looks like to have your rules met. And then when the rules aren't met, it's in red. So know the opposite side of it. Know what it takes to get you in, to have that advantage. And know what it looks like when that advantage is gone. And we're going to cover both sides of the coin for each and every rule this morning. There are client trades. There's about 350, 375 pictures in the green section of momentum, path, and entry, getting you into the market, out of the market. There's the entry sequence for shorts and longs, high probability trend trade. There's a very mechanical management plan. Management is typically where most of us fall short in the beginning. Guys, the entries are pretty easy. They're just patterns that repeat themselves. But management is where people start to get emotional. So I've created a very mechanical management plan that's focused on getting you in and getting you paid. And then you'll grow from there. So the orange section is as you create your own management plan. And then the blue section is just patterns that you see as you learn to read your indicators. There's the favorite looks section, and this is where you take your pictures, where you drop your pictures, where you come back and you study your pictures of these patterns, these entries, these management opportunities. So use the spreadsheet. I dropped it in the room for you there. Keep it simple, guys. Keep it focused. And I think one of the most important things is don't hesitate if you have a question. If you're uncertain about something that I've just said, just go, hey, Mark, I need you to repeat that. If you need another run through on entries or terminations, guys, or even momentum, just go, hey, Mark, let's hit that one again. I have zero time frame. Whether it takes me an hour or 3 hours to go through the basics, guys, I'm cool with it. The only people that won't get help in my classroom are the people that don't ask for it. Don't be one of those people. So, without further ado, let me figure out where my little thing is here. Here we go. Let's talk about rules. And let's start at rule number 1. Seems like a good spot. Rule number 1 says that on the large chart, I need strong trigger lines. And strong trigger lines are pretty universal no matter what chart you're looking at. When I look at a large chart, I'm looking at my workspace. The color of the background is going to tell me which direction I should be looking for rules to be met. If the background is green, we're in an uptrend. Let's look for rules to be met for high probability trend trades long. If the background is red, we're in a downtrend. Let's look for rules to be met for high probability trend trades short. Guys, let's go with the flow. Follow the large crowd. In order to have strong triggers in an uptrend, my small triggers must be above and away from the large triggers. The large triggers should be widening. And there's the space that's created between the two. The background's green, the larger green, the smaller green. And then once I get the space between the two, guys, I want you to picture scissors that have just opened and are ready to cut. This space lets me know that the odds are favorable for the market to continue up. You're going to hear odds favorable momentum in the classroom a lot. You're going to see it annotated on charts, OFM. In a downtrend, the background is red, the large triggers are widening, the smalls are below the large, and once again the scissors are open. All the colors match with open scissors, and guys, the odds are favorable for this market to continue down. Again, odds favorable momentum can push a market in the direction of the trend. Odds favorable momentum typically is what it takes to break those key Fibonacci areas. And then odds favorable momentum, this is probably why I love it so much, can cover mistakes that we tend to make as new users. It's almost giving us like a second chance in some cases. Momentum is the same look no matter what chart you're looking at. So whether it's a large chart or a small chart, if you're using one of those range charts, some of you do higher time frames and you do daily charts. Guys, momentum is the same no matter what. It's separation between the small and large, letting me know that the odds are favorable for the market to continue up. And there it is right there. There's that separation, and you can see the push. And then there's that separation, and you can see the push. And you notice that at the beginning of the move, momentum tends to be its strongest, coming away from those key Fibonacci areas. And then towards the end of the move, we get what we call weak triggers. And that's when those scissors close. When your small triggers work their way inside of the large triggers, this is weakness. And when I have weakness, anything can happen up or down. So the market daily is this roller coaster, going from odds favorable to anything can happen, going from up to down. And that's one of the wonderful things, guys. It's this volatility of the futures markets that gives us the opportunity to make money either direction with just a couple advantages. So strong triggers leads the way. Is everybody good with that? Can you give me a why? This is typically the easiest lesson that you're ever going to get. That separation between small and large lets you understand instantly whether or not you have momentum. And it happens on the most current bar. So this most current bar on the S&P, notice that the small triggers are inside of the large triggers, that there's not space or separation between them. Guys, This is a weak trigger look, and when I have a weak trigger look, anything can happen up or down. This is where you typically see bigger retracements, bigger pushes down, and very often this is the look that precedes reversals when you get to those key areas. And that's kind of the segue into our second rule. The large crowd reacts at those key Fibonacci areas on your large chart, guys. They make decisions there. So rule number 2 says no termination conditions, and it's basically reminding you, don't trade into the large crowd decision point so that you have room to your profit targets. And termination conditions really are just lines on your large chart. It can be divergence highs or lows, and divergence is a word that we use to describe a loss of momentum. Anytime there is a loss of momentum at a pivot, the market is screaming up, and then it pushes back down and it creates this pivot. Well, if momentum wasn't following price, meaning that there's less push going to the upside, you'll see that negative number in that divergence line. That divergence line off a pivot is not a termination condition, but it becomes a line in the sand that you'll see long before the market gets back to it, that can warn you that this is an area that may stop the market. The same is true with the divergence low. You're going to use red Fibonacci resistance and blue Fibonacci support, as well as these yellow 1-to-1s. And remind yourself, write it down on a piece of paper. Decisions are made at these key areas. Decisions are made at these large chart areas. So to identify one as a termination condition, it's a two-part process. And I do want to say one more time before we get too far into this, good morning and welcome to anybody that's new. I know we've got some newer names in here. I want to remind you that in the first day or two, it feels like a lot coming at you. Ask a million questions, even if you're not sure that it's the right question. But my promise to everyone in this room that's just kind of getting their feet under them, by the second or third day, the language becomes familiar, the looks begin to stand out, and I promise you, it begins to make more and more sense. Keep it simple, ask questions, guys. Termination conditions. We're going to allow the price bars to reach a line on the large chart. It's really that simple. Price reaches the area. Price reaches resistance. And then just ask yourself, where are my triggers? If your triggers remain below resistance, guys, you've reached a termination condition. This is an area that could stop the market. This is an area that may create an untradeable bounce. This is an area where large crowd buyers and sellers might fight. And guys, it could reverse the market completely. If I reach a line, the triggers remain below resistance, and it reverses the market completely, we call this a strong top. And a strong top just means that the decisions were so impactful at that key area that everything went the other direction, and it becomes the precursor for the highest probability trend trade that you can take. And then the market comes down and price reaches support. Remember, price reaches the area, it starts the decision-making process, and that's all we need price for. Once it gets there, it's 100% on the triggers, guys. If the triggers remain above support, no trades into that area of support. It's a termination condition. It may create a bounce. There may be a fight, and it could even reverse it completely. If it reverses it completely, it's what we're going to call a strong bottom. And that's the precursor to the highest probability trend trade you can take. That strong top and strong bottom isn't a rule for the high probability trend trade. Just kind of adds warm fuzzies when it sets up before. So price reaching an area is what lets us know that decisions are being made. And I want you to see this. Price reached support, and they retested it 3 or 4 times. And your trigger lines never broke. And the market went up from there. And it was these yellow 1-to-1s in support where the beginning of the whole uptrend started. And it was resistance where it began to go down. And if you scroll back for a day, you've got 10 days worth of data on every chart, tighten it up and see how often these key Fibonacci areas stop a market. And what happens is you begin to trust it. And you begin to realize that more often than not, trading into a termination condition is going to cost you money rather than make you money. And you just start to use that little avoidance. Hey, rule number 2 is not met. There's no trades into this area. Let me be patient. And guys, every line is going to be a termination in the moment. Price reaches it, right at that moment, it's a termination condition. Sometimes it holds, sometimes it breaks. Remember that the trigger lines are going to let us know the status of an area. If price reaches support and the triggers are above, this is a no-fly zone. This is a, hey, pump the brakes. Wait a second. Let's see what happens. Let's see if it reverses or if it breaks, guys. And once your small triggers and large triggers get below support, support's considered broken. Your path is clear. And your path remains clear until you reach the next area. Price reaches resistance, and look at where the triggers are. Everything is below, and you guys say, whoa, all right, let me hold on. Maybe I won't take a trade and hope that it breaks. I'll wait for it to break. And it's almost 15 bars worth of information before your small and large triggers get above resistance, and resistance is broken and the path is clear until you reach the next area. And what you'll find is that when support breaks, it takes on the role of resistance. And when resistance breaks, it takes on the role of support. And very often it's those strong triggers that make it happen. And I want you to see, whoops, what did I do there? This resistance breaks, and you can see that the market comes back and tests it as support. Support breaks, and they come back and test it as resistance. And you see it a few times. And you'll notice these tails or these wicks on the large chart. These are fluctuations in price, pullbacks on the small chart. And you'll notice that there's almost always some sort of price action fluctuation when a key area is reached. Whether it breaks or not, you'll see that there's a lot of fights that happen right at these key areas. And you'll discover that you don't have to be caught in their fight. You don't have to do it. Just let it break or let it roll. And it's always easier to trade away from a fib than it is to trade into a fib. So, you guys good with that so far? If price reaches an area and the triggers remain below resistance and above support, let's just wait a second. Let's see what happens. Once my small and large get below support or above resistance, the area is cleared. Guys, this is your high probability scenario. This is really the only option for the brand new users. Either your rules are met or they're not. And let it be that simple in the beginning. It's either a termination or a clear path. And what that does is it opens the door for the second trade for you. And this trade is on a plan that I'm going to give you. And this trade is called the 50-50 trade, guys. And it relies on momentum being the factor for these areas breaking. But your trigger lines will let you know when these areas have the potential to break. So if my small triggers smash through an area, but my large triggers haven't made it through yet, as long as I have odds favorable momentum, this is what we call a 50-50 look. 50% of my triggers are through and 50% are not. And if you take an entry with a 50-50 look, guys, you're taking that entry based on the potential of the area to break. Rule number 2 isn't met, and it's not a clear path. So this particular look is probably going to be the most common look, but it is not a high probability trend trade. It's what we call a medium probability trend trade because you're identifying a challenge, and that challenge is that the area isn't broken yet, which means that you'll have to rely on your chart reading a little bit to manage a bit more aggressively and to really speak out loud those other advantages to make sure that you're embracing the other 2/3 of the equation when the path isn't clear. And here's your reminder. There will be times when your path isn't clear because the areas are stacked. You're going to see it, guys. And this is 90% of your day. 90% of your day is doing nothing. It's just waiting. And it seems crazy, right? How can I make 6 figures, 7 figures a year doing nothing for 90% of the day? Guys, there's people that do it. The futures markets trade about $220 billion an hour. Trillions of dollars a day. To put yourself in 6 figures, you need to capture $400 a day. That's it. It takes $400 a day to put yourself in 6 figures. You don't need to be in every move. You don't have to hope that areas break. You don't have to be the first one in. You really don't even have to be the last one out. Grab 2 or 3 solid trades each and every day. Go play golf. And guys, Fibonacci gives you the ability to see where the driving forces of the market are likely to make decisions. And very often, rule number 2 is going to keep you out of consolidation. It's going to keep you out of chop. And again, this is 90% of your day. When you can't go long into or short into support or long into resistance, and you're just sitting on your hands and you're waiting. And then rule number 2 will define these areas of consolidation, these areas that you have to wait for the market to break out of, so that you can get your best of the best. Let's look at another market and just see if it does the same thing. Well, there's that rule number 2. From resistance, potential to break that didn't, potential to break that didn't, right into resistance, right back to support. And guys, it came from support. And there were opportunities in there. I can see them. But does everybody see how rule number 2 clearly defines trouble? It clearly defines where it may be a problem. I'm telling you, once you trust it, it takes so much pressure. Once you study these 3 rules and you learn how to see them set up, you realize that there's always another trade coming, guys. And once you trust this plan, once you trust this methodology, it's easy to sit on your hands. That 90% of the day becomes a much easier endeavor. So large chart has led the way, guys. Large chart always leads the way. Large chart is the large crowd, and they're going to define the direction. And they're going to provide the momentum, and they're going to show us what areas they may react at. And guys, once the large crowd says, hey, check it out, rules 1 and 2 are met, we're going to go to the small chart. We're going to go to the refinement chart. And we're going to pinpoint where that small crowd's likely to fail when they begin to fight. But there is one termination condition that happens on the small chart that I want to mention. This is the only time, guys, the only scenario where I'm going to say rule number 2 isn't met. I'm not taking that next trade, and that's 3 divergences in the same price range. 3 losses of momentum in the same price range might terminate the trend. 3 losses of momentum from a low, those 3 cyan lines, or 3 magentas from a high. This is enough for me to say, okay, rule number 2 is not met. Absolutely don't look for that entry area because I don't have a clear path. But if those if those divergences aren't there, we're going to use rule number 3 to pinpoint where the small crowd is most likely to fail. We're going to use rule number 3. You're going to be able to identify where the market is most likely to continue with the trend and the momentum and the clear path. And you're going to do it with such precision that you're going to use a limit order. You're actually going to wait for the market to come to you. And you're going to have it waiting at areas, fibs, mid-bands, and yellow 1-to-1s. And here's the key, guys. Those areas need to be inside of triggers. Because price returns to the large triggers, whether it's a large chart or a small chart. Price returns to the large triggers, guys. That's where we anticipate the price bars are returning. Whether it is the large triggers or the synthetic triggers, they're both large triggers, guys. One is not more important than the other. And both of those large and synthetic represent where these price bars are most likely to return. So if every time you look for a trade, hey, good morning, Miss M. If every time you look for a trade and you wait for that pullback, you say, hey, price may return to those triggers, it keeps you patient. And then price is most likely to bounce off of an area inside of the trigger. So I like to picture throwing a ball as hard as you can. And the trigger lines show you where that ball is likely to go. And then the areas inside are like the brick wall that the ball is likely to bounce off of. So when we're looking for an entry, remember that price is likely to return to the triggers. And when the rules are met on the large chart, this is going to be the look on your small chart. If my large chart is in an uptrend, if it has momentum, if the path is clear, my small chart is going to look like it's running away from me. It's gonna trigger that fear of missing out. And you've got to remind yourself that we're going to use a limit order to buy or sell a pullback at an area inside of triggers. So focus your attention on the large triggers and the synthetic triggers. Where are they? Are there areas near them, in them, fibs, mid-bands, yellow 1-to-1s? This is going to be my area to watch if that small crowd decides to fight. And you'll know that they're fighting because it'll give you a reversal bar. And a reversal bar is just a down bar after all of those up bars. And it says, hey, check it out. Now we're on the wrong side of the small triggers. We're losing momentum, and that loss of momentum, that fight from the small crowd, those price bars may return to the triggers, from the large to the synthetic, the top to the bottom, but I need areas inside to create a bounce. So I'm going to create like a window from the highest point of support to the lowest point of support inside of favorable large triggers. And this white box shows me precisely where the market is most likely to bounce, where it's most likely to continue, where the small crowd is most likely to fail. And I'm just going to activate a limit order a couple ticks above that box, above that highest point of support. And if the small crowd has it in them to push back, guys, I'm in a trade. I'm in a long trade with momentum and a clear path. I'm in a trade from the point where the market is most likely to bounce and continue with that trend, where the small crowd is most likely to fail. And once I define where the market is most likely to continue, and it could be from the highest point of support to the lowest point of support, guys, understanding where the market is most likely to continue gives me the ability to recognize where the market shouldn't go. So anything below those triggers, below those areas inside of triggers, about 4 to 5 ticks, guys, this is your first stop placement. This is where you say, they have to come get me on the wrong side of things, or I'm going to stay in this trade with all those advantages. And then if they do decide to give you that run in the direction, you're going to get another reversal bar. The first reversal bar helps you define your entry. The next reversal bar says, hey, we're doing everything from right where you thought we would. And this is going to be your first stop movement, guys, a couple ticks below that, because now you have a market going up in an uptrend with momentum to the upside and a clear path to the upside. There's no reason to leave any extra risk on that trade. And that's why this refinement chart gives you the ability to really reduce risk and to really maximize profit potential. I need to rearrange these. And that's where I came up with this picture and why I labeled it the way I did. I've got 3 numbers. I've got red, yellow, and green, guys. And the red number 1 is you guys that like to jump in, afraid that the market's going without you. And you're like, well, I've got momentum and a clear path. I'm just going to jump in and hope it goes to the next area. And that's cool, right? But very often we get these retracements. So if you jump in, your stop still goes below the triggers. That's an enormous amount of risk. If all you're relying on is a momentum look to get you, hey, Miss Adriana, to the next area, this reversal bar is that loss of momentum, guys. Let it be an exit. The next most common entry is the second entry here. When it doesn't quite get to your entry and that small crowd are pushing the other direction, you get a little fluctuation and your heart drops and you're like, oh, they're not going to get my entry. This sucks. I better jump in. And guys, I see so many entries right at the top of a bar that never even becomes a reversal bar. And sure enough, they go back down to the area. All you've done here is increased your risk dramatically once again. But if you wait for the pullback to areas, guys, that's the least amount of risk that you'll ever have. And then the flip side, going the other direction, if I jump in up here, I've only got 6 ticks to Fibonacci resistance. If I jump in the middle, I've only got about 12. But if I get in all the way down here, guys, I've got 24, 25 ticks to get me to that target, giving me enough room to make some money. And these are all very common. So the best thing you can do is learn these looks, guys. Learn momentum all by its lonesome and get good at it and say, okay, I understand every time there's a separation between the small and large, it means strength. And if it's all green, it's strength up. And then understand whether you have a termination condition, whether it's the potential to break, or whether it's broken, that clear path. And what you can do is you can go back and build some faith in this look, guys. Is when I see momentum in a clear path, or even momentum in the potential to break, you're going to see these tails on a large chart, guys. And remember, these tails are just the pullbacks on the small chart. Go circle the bottom of a tail for a long or the top of a tail for a short. And if it lines up with an area inside of favorable large triggers, guys, you have a high probability trend trade. And this goes into that idea that you have to know what looks you're going to commit to. Take that picture, drop it into your spreadsheet, and remind yourself, this is the best of the best. This is exactly what I want it to look like. And if I go through a couple of these, momentum and clear path, and it pulls right back to support inside of favorable large triggers. We'll go to the next one. This one says, this is my long. Holy smokes. Odds favorable, potential to break, pulls right back to support, right inside of favorable large triggers. Guys, all it is a pattern. And this pattern repeats itself every day. And the cool thing is this pattern repeats itself on every market. Whether it's a stock market or an options or futures, it can be Tesla. Guys, this all it is a pattern. This is your cheat code to the highest probability trend trade you can take. But you've got to learn this look so that things become easy. And when the market is caught in a range, it's not easy. But let's go back and see just for grins. I'm going to circle this tail when it had the potential to break with all that momentum. And let's just see what the tail looked like on a smaller, faster chart. Zip it up a little bit there. Support inside of triggers, support inside of triggers, support inside of triggers. That one might have gotten you, but you'll notice that the one that might have gotten you was after 3 divergences in the same price range. And then the market continues up and it pulls right back to support inside of favorable large triggers to go with that continuation. So guys, start studying these looks. Ask a million questions about the look. Are there any questions about the high probability trend trading? Guys, remember, you are brand new in some cases. So are there questions about strong triggers, that separation? Are there questions about reaching an area? Where are my triggers? And defining an entry. So this is what you're going to do for your first 20 days with me, guys, is you're just going to focus on chart reads. And the easiest way to do that has nothing to do with taking trades. It has everything to do with taking pictures. In order to get to where you want to be, you've got to recognize some looks and patterns, and you've got to be able to do it fast, guys. The market's moving. The more pictures you take, the more you slow down the market because you know exactly what you're looking for. So I'm going to encourage you guys. I'm not going to force you guys because I can't do that. I'm going to encourage you to take 25 pictures of strong triggers, to take 25 pictures of weak triggers, to take 25 pictures of a clear path, and to take 25 pictures of termination conditions. Because once you know the difference between the two, you have everything that you need to have a confident, profitable, consistent trading plan. Go take pictures of those high probability trend trade entries. Quick little tech help. Rerun the template GWC. I'm not sure why they went away. What I would do, there's two things you can do. You can right click and you can reload the template. Just 13.2, I didn't see what market that was. Or another thing that you can do is just click on your chart GWC and hit F5. And what that'll do is that'll reload the Ninja script. And a lot of times that'll get them back. Or you can right click and reload all historical data. So there's 3 options. One of those should work. Worst case scenario, none of them works. Build a new chart. Awesome. And remember, if you can't seem to get it, let Jason do it. He'll do it in a matter of seconds for you. So guys, go take pictures. But don't just leave it at taking pictures. Don't expect your brain to remember what you were thinking when you took that picture. Annotate your charts. Guys, writing on your charts creates this connection between the visual and what it means to you. So talk about why the triggers are strong, right? Use those words like there's separation, they're angled in the direction of the trend, the colors match, and really burn that look into your brain and the words that describe it. And the same thing with termination conditions, right? Write that process. Price reached an area, my triggers remain below. And if you do that for each individual picture, what you're going to find is that the time that you spend typing and analyzing and posting it into your spreadsheet, it reinforces not only the looks, but the advantages to be had or lost with each look. So when you look at strong triggers and you take that picture, notice that small below large, all red, space between means strong, momentum, rule number 1 met. Guys, you can't type that 25 times with an arrow and ever confuse this look for weak triggers. And then the same is true if you go to weakness. And you look at it and you say, when my smalls are inside of the large, this is weakness, anything can happen, rule number 1's not met. You can't take 25 pictures of that and screw it up and say, oh, I had odds favorable momentum to the upside. You'll be like, oh no, I'm fooling myself. I'm breaking my rules intentionally. Let me reel myself in and wait for that advantage of momentum. So this chart reading 101 feels like work, and people hate it. I don't have time to take 25 pictures. I'd rather just blow out accounts for the next 2 years than get this stuff solid, he said in a sarcastic voice. As you take these pictures, guys, why not use the cheat sheet? This is the high probability trend trade checklist. This gives you those pictures straight from the lessons of exactly what it means to have your advantages. The first thing on the checklist is the market coming from a strong top or bottom? That termination that reverses the market, that's exactly what it looks like. There is strong triggers, weak triggers. Know the difference. Commit. There's your termination condition because no triggers are through. There's your potential to break because the smalls are above and the large are below, and that odds favorable momentum is there. And then there's your clear path, guys. Small and large above. And there's your window of opportunity. There's that defining the point where the market is most likely to continue. And then finally, there's a checklist that you can print out and put on your desk. And Morgan, oil just jumped. Guys, remember, this is a holiday week. This is a holiday week, and there's a lot of people that do this for a living that studied and got feedback and practiced, and they're taking the week off. So there's going to be some emotional stuff maybe. The big dogs can push a little bit. Brace yourself. We're not in control. They are. That's awesome, Morgan. But they were range bound, right? Do you remember that? Do you guys remember looking at crude oil together just a minute ago? And they were absolutely range bound and couldn't figure it out. And then once they figured it out, sorry, that's the S&P. And then once they figured it out, guys, it was gangbusters right to the next fib. And look at that. To the freaking tick. And did you see all that momentum? And there's one of those tails. Some of you probably capitalized. And notice that it came from a termination. 1, 2, 3 areas that the market was unable to break. It rolled, became a strong bottom. Destroyed your market flow chart. That happens. And guys, now we're coming off a termination. This trend trade checklist is designed for you to print out and put on your desktop. Some people print it out and they laminate it and they get a dry erase marker and they say, hey, check it out. Now I don't have to kill trees. I've never had anybody in the history of this checklist do worse than 70%. So for you guys that are still pretty new here, Andrew, ATM, guys, never done worse than 70%. I hope your goal of trading is to win more than you lose. I hope your goal of trading is to make money. It makes sense as you learn to read your indicators to follow a plan that's been proven to win more than it loses. And that's kind of another segue, guys. The KISS plan. What is the KISS plan? Guys, the KISS plan, that's too small. The KISS plan is a stepping stone in your learning journey. I said it in the beginning that this isn't your only trade. This is your first trade, guys. This isn't your get-rich trade. This is your pathway to being able to recognize your get-rich trade. And it's designed to optimize your chances of success with a high probability trend trade as a new user. That's all this is for, guys. This is something to keep you focused on until you're reading your charts, until you're developing good habits, until you're following your plan. And this is also a great fallback for you guys that come into class and you're like, man, I've been with Nexgen for 8 months and I can't find schnikes. I'm not going to cuss today. I'm turning over a new leaf. Guys, this is a great way to come back and get your feet underneath you. Back to basics. And I love it because you guys that do this, you're like, oh, it's not hard to win if I just look for advantages. So through simulation, study, class feedback, continuous practice, guys, you're going to create your own plan. And your plan is going to be based on your ability to read your indicators. So your simple plan for consistency, brand new users or you guys that aren't where you want to be, don't fight the large chart. But I need to be in first or I'll never make enough money. It's poppycock, I say. Balderdash. Guys, You've got the greatest software in the world. You know how to identify momentum, path, and entry. Just wait. Wait for it to be your trade. Wait for it to be your money. Guys, define your entry. Get into the market. Thank you for that, Gino. Define your entry. Get into the market where the market is most likely to continue. Gino's my lawyer. He speaks for me on Tuesday mornings. Once you define your entry, guys, once you can define where the market is most likely to continue, you understand where the market shouldn't go. So your management plan is based on your ability to recognize entries. Guys, give it 20 days. Stop being in a hurry to be a millionaire. You're like those people that think they're going to lose 50 pounds in a week when it took them 3 years to put it on. Your management plan is based on that great entry, guys. And your first stop placement, when you enter at a point where the market is most likely to continue, your first stop placement is 4 to 5 ticks beyond those trigger lines where the market was likely to continue. 4 to 5 ticks below the lowest point of the triggers, guys. This is your stop. And just leave it there. Don't move it. Don't move it up because you're afraid to lose. Don't move it down because you think the market needs all the breathing room. Give it 4 to 5 ticks below the triggers, guys, and just say out loud, they're going to have to come get me. Remember that you took this entry because of momentum, because of a clear path, because you know precisely where the market is most likely to continue. And more often than not, it's going to continue in the direction of your trade, and it's going to give you that reversal bar. This is your first stop movement, guys. Your first stop movement is 2 ticks below that reversal bar in the direction of the trade. And then there's nothing to do. It's either going to hit your first target or you're going to get stopped out. You'll never be in control of that. And anything that wins 70 to 80% of the time, it's obligated to stop you out 20 to 30% of the time. It has to produce that loser. As you grow with chart reading, you'll be able to manage even better. But in the beginning, let's just focus on going through the mechanics and getting paid, guys. And this KISS plan management is designed to take the emotion out. It's designed to get you paid. And your first target in the KISS plan is only $100 away from your great entry. This is an S&P chart. And if I was in at 66.50, I'm taking a contract off at 68.50. And that is $100 in my account. And that's $100 worth of confidence, guys. And my sweaty palms are drying up. And I got nothing to lose. I've got nothing to lose, and my large chart still has momentum and a clear path. And you're either going to get stopped out, break even, or it's going to go to your second target. And I'm going to tell you in the beginning, there's probably going to be a lot of break even trades in there. And that's okay. Break even doesn't sting. It doesn't do anything to the ego. But if you go the distance, if you go to that second target, it's only $200 away from your entry. And guys, with all those advantages, it's not difficult to hit. And it's not odd to see you guys hit a $200 target, make it a $300 trade, and then things change. And that's okay because you got paid. And that's the goal of trading is to get paid. So the KISS plan gives you the ability to get in where the market is most likely to continue, to manage it. Very, very emotionless, very opinionless, guys. If I enter, then my stop is 5 ticks below the triggers. If I get a reversal bar, then my stop is 2 ticks below that. If my first target is hit, then I'm break even. If my second target is hit, guys, I'm out of that trade, and I'm out of that trade for $300. And if that's the best that you do every day, and I love this sheet. This is my favorite sheet that I share with you guys. $300 a day, if that's the best you do, even if it's 3 break-even trades, guys, that's 75 grand a year. And very often, I get you guys in this room, they're like, oh, I have to make $1,000 a day. I know I'm a brand new trader, and I've never really logged 30 days of success in a row, but I have to make $1,000 a day. And you just continually blow out on your quest to 1,000. Guys, learn how to get paid. That's the goal. Once you learn how to accept payment, you start accepting larger payments. That's just kind of how it works. One extra break-even trade puts you in 6 figures. But what you have to know before you get into the market live, before you ever start that prop firm, before you ever open that live account, guys, you have to have a plan. And that plan better identify your entry, and that plan better tell you precisely why you're going to get out of the market. Because once you leave either of those open to emotion, that's where problems happen, guys. That's where traders get in trouble. Your gut will lie to you. Because your entry rules are nothing more than patterns that have been proven to repeat and proven to win more than they lose. So your high probability trend trade is a pattern that is testable. It's a pattern that's verifiable. It's a pattern that you can develop trust in. And if you take 100 pictures of this pattern, it's likely to win 70 to 80% of the time. So rules eliminate the need to know what's going to happen. The pattern tells you what's most likely to happen. And anything that wins 7 to 8 times out of 10 is going to lose 2 to 3. And then your exits have to be defined as well, guys. And your exit conditions are just identifying when your advantage is gone. I haven't reached my target, but 3 divergences print. I haven't reached my target, but the large chart hit something. And guys, once you have this, it's just rinse and repeat until the emotion is completely gone. So one of the things that's important to understand is that the rules for a high probability trend trade are different than the rules for a 50-50, which are different than the rules for a momentum trade, which are different than the rules for an HVA trade. And if you're trying to catch all of them before you're really good at one of them, you're very prone to mixing the rules, to mixing the management, to making mistakes that are detrimental but avoidable. And avoidable losses, guys, avoidable mistakes are what we're looking for. So, boom, 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 as we come into the 10 o'clock hour, and cheeseburger confidence, guys, CB confidence at 10 a.m. So we're 5 minutes out from high impact news. I like to say that I'll give you guys everything you need to be successful. So we've learned the rules. We've learned the trigger line looks for when it's okay to trade. And for you new guys, tomorrow's first hour is going to be exactly like this first hour. And then after the holiday, every first hour of every classroom is the exact same thing. Repetition breeds recognition. You guys can simulate, you can practice, you can take pictures of things you don't understand, and you can drop them in the room. In 15 hours every week, it's live to give you feedback. And that's really kind of the magic of what we do. You don't have to know how to trade. You don't have to know what it takes to get in and out as a brand new user. You just have to be willing to drop a picture in the room and talk about it and say, hey, Mark, here's my read. Is it right? And I'm pretty warm and fuzzy. I really am. I'm pretty gentle. Simplify, keep it focused, guys. Learn to do one thing well before you add another. Be a one-trick pony. It very often be enough. You have your rules, you have your plan, you know how to study, you know how to go back and verify, guys. You have everything that you need to be able to read a chart and to be successful. So now my obligation to you is done. Now it's your obligation to yourself. How much are you going to put into this to get reward? How much time are you going to spend studying? How much time are you going to post in the room? How many times are you going to show me your reads so that I can help you? Or are you going to sit on the sidelines, watch a couple videos, and hope to be great at it by osmosis? And it rarely works. Chart question. How do I get my large chart mid-band on my small chart? Let's see if we can do that for you, and then we'll take a break. Let me close all this stuff out. Oh, before we do that, though, because I just saw something shiny, I'm going to give you guys this zip file, and it's literally called Everything That You Need. And that is the Chart Reading 101 exercise. That is the High Probability Trend Trade Checklist. That is the KISS plan. That is the entry and exit conditions. That is the daily goal sheet. And it's also the PowerPoint that I use to teach each and every day. And all of these are not only in Word and PowerPoint, but also in PDF. So it's available to everybody, guys. Take them, download it, study them, look at them. And then, Wayne, right-click on your small chart and go to your indicators. And go to T3 Fibs ProTrader Synthetic New. And then we're going to go down 13.2, support resistance, plot midband, and make sure that you check it. So we're going to go indicators, T3 Fibs, make sure you're in the 13.2 time frame, plot midband. And then when you do that, let's see. We'll see if it plots the midband. It should. There we go. There's your midband right there at 79. Some of you are like, oh, do I need to do that? Do I need to plot a midband? You don't need to. There it is right there in the same darn spot. Some people don't like to look left. Some people have the brain capacity to look at more on one chart. I don't. I'll tell you right now. Less is more for me. The fewer moving parts for me, the easier it is for me to wrap my head around what I'm looking at. Not everybody suffers my affliction though. So if you guys have questions like that, adding indicators, changing stuff, feel free to ask. I'll always go over it with you. But for me personally, I choose to not have that on my charts because I can't find an advantage. Yeah, and I know that you use those for targets, Wayne. Check this out. It works the same. But we all see things differently, and that's what's pretty cool. I know it's at 77. There's a good target. All right, guys, I'm going to take 5 minutes. I'm going to go stretch my legs real quick. So when I come back, we're going to look at your charts. We're going to talk about what you've posted. And on everything, guys, and here's a big deal. On everything posted in this room, I go back to momentum, clear path, and entry. No matter what, I go back to momentum, clear path, and entry. And I do it because this is an educational room. And the key to everything, let's bring this up, is building a foundation. Oh, and I did put that picture in there, guys. I discovered this word last week with y'all, Kaizen. And it means focusing on small improvements every day and not waiting for big improvements, but trying to become 1% better every day. Instead of setting a big goal, divide it into multiple small goals. Tackle each one of them one by one. So tackle momentum and then go to clear path and go to entry area and try to be a step better every day. But the reason that I put this in there, and I want to share this with you guys, because a lot of times people want to be the trade police in this room. They want to say, well, he broke this rule, he did that, he did this. I don't know. I don't speak German. It might. Guys, for you new users, I'm going to blanket you with very conservative rules, and it's going to feel that way. It's going to feel like I'm stifling you a little bit. And I'm going to give you the ability to recognize advantages, and that's what we're going to work on together, is just your chart read. And I'm going to hand you that solid plan that optimizes your chances of success as you learn to read your indicators. So for all you new users, guys, terminations are bad, and no momentum is bad, and blanket and entries not inside of triggers are bad. And that's how it feels, but that's not the truth, guys. The more time that you spend with stuff, you're going to know when to break your rules a little bit, or when to fudge your rules, or stretch them a little bit, or change them. Change your trading plan because you recognize a pattern. The more time you spend with things, the more you're going to see. So I encourage you guys, learn the process first. Learn the execution of the method, because that's what yields the results. And that's where the KISS plan comes in. If you keep it basic, if you follow simple rules, if you're all right not keeping up with the Joneses, guys, you can find an extraordinary level of success as a brand new user. And I've watched it happen over and over. I've watched people get funded in these prop firms in their first 30 days with Nexgen with nothing but the KISS plan. And question everything. And I think this is the most important thing. Guys, don't feel like it is combative if you ask a question. Don't feel like you're fighting me. And even if you are fighting me, that's cool. I love a good fight. We'll keep it respectful. But if you don't agree with my assessment, go, hey, Mark, you said that was a termination condition. I don't see it. I don't think it is. And we'll go back to the very core rules and we'll talk about it. So let's do that. I'm going to walk away. I'll be back in 5 minutes. Guys, go stretch your legs. When I come back, we're going to scroll through the chat box and just start clicking on charts. So see you in 5. All right, guys, let's get back to work. So I'm going to scroll up and take a look at pictures. Reminder that, guys, ask questions about all of them. If you see something going on and you're like, man, that's not mine, but I wonder what the heck's going on, feel free to ask. If I understand somebody's plan, I don't mind sharing it. Everything posted in the room is fair game. 100%. So we're going to start with Andy. And let's see, Andy said, triggers roll from a strong bottom. And then Andy, I have to disagree with you. Because when your small triggers break through the fib, it's no longer a strong top or bottom, guys. A strong top or bottom, and we're going to go through a couple different lessons here. So a strong top or bottom is a termination condition that reverses the market. And what we have here is the potential to break. And I think what will happen is you guys associate words with it. Let's make this bigger. That was the PDF version. So first you get a termination condition, which is price reaches the area, the triggers don't break. If that termination condition reverses the market, now it's a strong top. And I'll give you guys this one. Here's the PDF version of that. And this is a good lesson, and it's not important, like that strong top or bottom isn't mandatory for the next trade, but it really does kind of set up and give some warm fuzzies. So when we look at your chart, Andy, not really a strong bottom, but what you do get is a failed 50-50, divergence prints, and then price passes trouble, buy two, and out at target. So what you did, and I love this, Andy, and guys, I'll do this a lot. It may be an out freaking standing trade, but if I read an annotation that's incorrect for what I teach, I will go back and I'll correct the language. So this is not a strong bottom, it's a failed 50-50. Andy knows that divergence is one of the biggest killers of 50-50s, and once he gets past the area that could create a potential bounce for that short trade, look at the momentum. And his small triggers have the same look here, and he says, well, that's a quick little hit right up to trouble. And Andy, beautiful, beautiful chart read, would be an awesome trade. And the fact that you understand it's not a home run, that you're still fighting some stuff, but in the moment, it's a great chart read. I love everything about it. Just good lesson on the strong top or bottom. And then the short, I think these were in a different order. So bad top, potential to break, divergence prints, guys, on a 50-50 trade. Divergence is the number one killer. And let me go back to the KISS plan, because I did give you the 50-50 plan in here, and I want you to see it. And guys, this is the same way the high probability trend trade is defined or designed to optimize your chances of success. So is it on the 50-50. And let's do this, Andy, just because I think this is a good lesson for everyone in the room. I hope you don't mind. Even if you do, I'm going to do it. But I hope you don't mind. So let me fit this real quick. And what I'm going to do is I'm going to take a picture of Andy's chart. And I'm going to take the rules for the high probability trend trade, or the 50-50 trade. I'm just going to drop them up here. And I want you guys to see this, not because I want to beat up Andy. I mean, it's fun to beat up Andy, right? But let's go through the whole concept on this potential to break trade, because a lot of people lose this trade, guys. This really is. This is probably the most common loser, and it's avoidable. And the first thing is it says one area not broken, and that's the best way to take it. And remember, you will create your own plan for this trade with a little experience. So Andy's only got one area that's not broken, and we're good there. Is it coming from a strong top or bottom? And it's not, because my trigger lines got through that divergence high. They got above that fib. So guys, this is not a strong top or bottom. So already it's one strike against me on this medium probability 50-50 trade. And you've got to learn that strong top or bottom from the high probability trend trade, or you run the risk of messing this lesson up. Do I have odds favorable momentum on the 13-2? Absolutely I do. Do I have it on the small chart? Without a doubt, guys. So right now I'm like 2 for 3. That's not bad. I still feel pretty good about it. And then it says no divergence on the 5-1. And there's that divergence, and I have to mark no. So now what I'm doing is I'm only running with 50% of my advantages, guys. 50% of my advantages on what's already a medium probability trade. This is what I consider to be an avoidable loss, because I gave up not only the strong top or bottom, but also the divergence. And on this KISS plan, I'm so adamant about the idea that divergence kills this trade that I put it again. I reminded you, man, don't do it with divergence. That's the one that kills it. And then when you open it again, did I close that KISS plan out? I did. I want you to see how important divergence is, guys. Because when you go to management, it reminds you for the third time that if divergence prints, exit that trade. And then Andy, I love this, and honesty is great, right? He chose to ignore the divergence with the wide triggers on the lower trade. He said, because of this level of momentum, I'm going to ignore that divergence. And he took a nice sell, and he got a quick target right at the area he was hoping would break, and got out break even. And Andy, I think that the biggest lesson here is if you choose to take a trade that isn't a high probability trend trade, be ready to manage it aggressively. And that's exactly what you did. And you really turn lemons into lemonade here. So nice job. Good lessons in there, guys. And this is what I like about you guys posting in the room is there's outstanding lessons. Even if you don't need it, someone else in the room might appreciate it. So Pete says, strong tops, triggers rolled, down, wide separation, odds favorable momentum, and a clear path. That was for your short trade, and it was pretty easy to take that trade with this look. And then directly into a termination condition, 2 divergences against it, everything rolled. That's an avoidable loss. That is certainly an avoidable loss, guys. So for those of you that are brand new, well, I'll just hope that these areas break. Very often they don't. And the difference between a novice and an expert, this is a lesson I learned from racing motorcycles, is your ability to recover. When you make a mistake, when you take a chance and it doesn't work, your ability to see the other side and go, whoa, that was the wrong trade. Let me amend my ways and take the right trade. And dude, your recovery is outstanding. So hold on, I stink at math. I want to do this real quick. And I'm going to show you guys how this works. So 8 ticks times 25 contracts. Oops. $80 times 25 contracts. That's so wrong. That was not a $160,000 loss. So that was a $2,000 loss, guys, and a $6,000 win. And you can take losses as a day trader, but don't miss the good ones. And I think this is awesome, Pete, and this is such a great example. Your winner was 3 times bigger than your loss. Guys, that's a recipe. When your winners are 3 times bigger than your losses, you could win like 30-40% of your trades and still be golden. So, Pete, great recovery. Awesome trade. And then one of my favorite things to see is when you realize that trading in determination conditions isn't your best bet, it makes it easier to get paid right at the termination condition. You're like, wait a minute. That's pretty impactful. Let me get out of this trade. Pete, great trading, dude. And thank you for posting losers along with winners because there's so many great lessons in the losers. There really are. I think that the losers produce better lessons. There's your termination. Everything rolls. You get your white bar off of it. You take your sell. You get paid. And then your second target is right above the mid-band. And it's just easy. Great trade. Absolutely beautiful, Wayne. And guys, this is kind of that next stop. Once you begin to recognize these termination conditions, these strong tops and bottoms, you're also going to be able to recognize patterns that help you get in sooner before the first trend trade. And that's exactly what Wayne did here. And that's an easy $360. Nicely done. Little more advanced, but this is where you guys are headed. All right, GWC. Did you get everything back, GWC? I don't know if he's still in here. Yeah. Did you get your fibs back? All right, Rob, are you with me? No, not with me. Maybe with me. If you're not with me, you're against me. All right, so Rob, if you just jump into a trade without a pullback, what's your exit strategy? Is it giving up 7 points? No, that's your target. So hold on, let's go back. $300, no, that's your target. So Rob, what you've done is you've confused a target. So a target is where I hope it goes. An exit is when I see my advantage is gone. Does that make sense, everybody? There's a big difference. Just because you put a green line out in the distance doesn't mean it's going to it. So, Rob, okay, that's great. That's your target, right? So, and let me show you what I mean. And this is for everybody, not just you, Rob. If I get in right here, my target is $300. If I get in right here, Rob, my exit is a close on the wrong side of the triggers because my advantage is gone. My target is still $300 in the distance. I'm never going to reach that target because I've lost my advantage. Does that make sense? So Rob, if you choose to jump in, that's your giant red flag that your jump in isn't working. And you, if you're giving away 7 points, okay, I know. That's exactly what I asked you, Rob. And then you gave me an answer that told me that you're confusing targets with stops. So I tried to clarify. To only get out at your target is asinine. That's the word I'm going to use. Your exits should identify when there's a loss of momentum. Rob, if you jump, well then why the hell am I even looking at your charts if you know all this? That's a rough stop, dude. Fix it if you want. All right, who's next? Morgan. Whoa, that may be the biggest market flow bar I've ever seen for the 1 minute spike. And then Kurt, you saw the same thing. Look at that. That's a crazy bar. You guys using these 1 minute charts, do you know how you're using it? Did John give you some insight on that? I love it. I just want to... Rob, you're getting stopped out. You're getting stopped out because that's not a trade. You're getting stopped out because the market goes against you. That's all you need to know. But that's not the problem, Rob. The problem isn't you getting stopped out. The problem is you getting stopped out 7 points instead of getting stopped out 7 ticks. That's the problem with your trading. You're giving up, golly, let me do the math, $187 worth of profit instead of only giving up $87 worth of profit. How many times do you need to do this before you're like, F it, I'm done for the day? Why not take smaller losses? That's what I'm trying to help you with. We went over it every day last week. If you jump into a trade, there is a very clear exit condition. And that very clear exit condition, if all you do is jump into a trade, is that reversal bar that closes on the wrong side of the triggers. Get the hell out. Your trade is done. Your momentum trade is over. You don't have momentum anymore. Stop holding. Well, you know what? Do it, because I don't give trading advice. But if my wife did that, I would tell her, honey, stop wishing it would just go down. Your trade is over. Get the hell out. Wait for the next trade. It's coming. That's what I would tell my wife. You have a very clear visual that things have gone wrong. Accept it or don't. Totally up to you. David, it just depends, man. I would have to see the whole trade. A lot of people are using a 1-minute chart with a market flow because my brother came in and taught this classroom. I like it. It's the same way you would use an 8 range. It's the same way you would use an 8 range, but there's more to it than that. John came in and he's saying, okay, if I'm looking for an entry, all it is, David, be on the right side of it, right? If everything is screaming down, don't try to go long against it. And if everything is screaming up, don't try to go short against it. Let it roll. That's the short version. Don't fight it. With that 1-minute market flow, don't fight it. If the triggers aren't right, it's okay if it's not your trade. That's it. It's just momentum on a different chart. Choosing not to fight momentum. So everything says down and the market keeps going down. You reach key Fibonacci areas. This was the bottom of that range. And then check it out, David. It didn't give you a chance because that was the spike off of it. But notice that it got to the other side of those small triggers. And that's when that thing rocketed up. Pretty cool. Yeah, it's just another range chart. It's just market flow. My brother uses it different. Probably than anybody in this room is going to use it, to be honest with you. But he likes it, and I'm going to tell you guys, every time he likes something, he gets excited about it, and he shows it to you guys. And this is where I get more people blowing out accounts, and it's not John Novak's fault. He's just sharing knowledge with you. But everyone goes, oh, John Novak does it. John Novak does it. Let me incorporate it into my plan without taking pictures, without studying it, without looking at it. But let's look. If you were thinking of taking this short trade, and one of the challenges is my circles don't print onto this 1-minute template that he created. But they will go the other direction. That was just too emotional because of that. That didn't work. So if you were looking for the next short, if you were like, man, I want to go short from here. I want to go short from that point right there. Do you see how with these up strong, don't do it, don't do it, don't do it, don't do it, don't do it. I don't know where it's going to happen. There was your first close, right at 69.65, which was enough because it would keep you from entering here and waiting for it down there. So it's just patience is really all it is. It's another range chart. It's another thing to look at. And guys, I'm not going to lie to you. You don't need it. You don't need it to catch high probability trend trades. You don't need it to take a 50-50 trade. Where I feel there's a huge advantage from these range charts is using it like Wayne uses it. And let me show you what Wayne does. One more time, let's revisit. When Wayne has a termination on the large chart, and his fast triggers roll and he gets a white bar, the second bar. Wayne says this is great confirmation that that's more likely to hold. And he goes rock star and he takes that short trade. And this just kind of sets you up. It's that trade before the trade. I think that's probably one of the best ways to use it. And you're right, David. There's a lot of stuff that John Novak uses that a lot of people don't. I have a personal rule where when John gets excited about something, I have him trade it for 30 days. And then if he's still trading it 30 days later, then I will follow suit. And I can tell you guys, with what he's using in this 1 minute stuff, the part you guys don't see is he spent 5 weeks on simulator getting good at it. We talked about it this morning. Guys, give me a Y if you can hear me. Is it just me? Is it just Morgan? No sound? All right. One second, guys. All right, you can probably hear me. But I can't get back to the room yet to see you. You guys have me back? We good? All right, awesome. So one of the things that you guys don't realize, and I think this is such a big deal that nobody talks about, or that I talk about all the time, and I guess nobody believes. I had someone tell me once, they're like, well, you just make it look easy when you read charts. And I'm like, well, I've spent 4.5 years and 15,000 pictures doing it. And John Novak has spent 27 years doing it. And guys, it takes a little bit. Learn your patterns. And I'm trying to find where, it was this morning that we talked about it. So this was from John Novak at 7:30 this morning, and I want you to see this. For you guys that want to take something brand new and run with it instantly, guys, it took 5 weeks at least to smooth out until he picked something. That's what John Novak sent me this morning. What does stream mean, Morgan? Nothing on the stream? Sorry. That's okay. I wasn't looking at anything. There we go. Better? Sorry. Thank you for that. We were talking about it, and he's like, yeah. Took him 5 weeks to smooth it out. Guys, he wrote the software. He's been trading for 20 plus years. Don't be in such a hurry. Take some time. Do some study. Learn some things. I guess that's where I'm going with this. Is don't feel like you have to be a pro on day one. You don't. So when you see something brand new introduced, guys, it's okay. Take the time to learn it. Take the time to study it. I'm about 5 weeks in too because I was learning something new. I refuse to get off simulator if I'm not comfortable. It doesn't make sense. All right, took this on the small account and the big account. Not the best chart look, but trend is down. Path is clear. It pulls right back to resistance. Guys, can you see the picture? I can see it. It's showing that I'm showing. No? Okay, hold on. Yes? No, yes, some. Hold on. Let me kill it and restart it. We got a mixed bag here. How's that? Is that better? Okay, cool. So if you're spinning, maybe you should do a reboot. Pete, this is one of those times, and guys, I'm going to go through this, and Pete, thank you for being the provider of the lesson. So guys, I don't have momentum. I do have a clear path, and I've got a very solid area of resistance that's likely to hold based on the trigger look. On the small chart, I don't have areas inside of favorable large triggers. I have no idea if it's going to be a mid-band, a fib, a fib, a fib, a one-to-one, a fib. Once you get to the wrong side of the triggers, guys, there's no telling where that market's most likely to stop. I didn't show John's chart, Wayne. I didn't show any of John's charts. I just posted a quote where he told me that he took 5 weeks to smooth out something new before he went to trade it live. That's all it was. For you guys that feel like you have to take something brand new and add it into your trading plan on day one and trade live with it, I'm just saying, the guru himself took 5 weeks to work through stuff. So without momentum, without areas inside of favorable large triggers, 2/3 of the advantages are gone. One of the things you guys can do, why not just wait for a reversal bar? Wait for that confirmation bar, because then it establishes your risk and it allows you to say, okay, now the market's going in the direction that it should be going. And when you should have waited for the reversal bar. Yep, there we go. Entry would have been the same. Amen. Thanks, Pete. Sorry, I got so caught up in the lesson I stopped reading. I know you know it. I don't worry about you, because where you put your stop was behind the area most likely to stop the market. I know that you define your risk. This is one of those things, guys. If you just wait for the confirmation bar, force it to go in the direction of your trade. I don't have momentum. My path is clear, but I don't have areas inside. I'll force them. I'll force the sellers to start pushing it down, and then I have some place to put my stop. I love it, and what a great hold all the way down to the fib. And Pete, you know your next level. You've been doing this a while. Your reads are good. Your plan is strong. And you take chances every now and then based on your ability to read the charts. And there's nothing wrong with that, guys. That's kind of what day trading is. And you'll get to a point to where you say every now and then, man, I know that I don't have the best momentum, but I'm stacking these other advantages. I know that my entry is not inside areas of favorable large triggers, but because of the look here, I know where to put a stop, where it makes sense. And you just start growing, and it's a lot of fun when you start growing, because you will see more opportunities. This is why divergence lows are termination conditions, guys. And I think I may have just killed my chart. This is why divergence lows are termination conditions. To the tick. And since I don't have any other pictures, let's create a lesson on these divergence lows, and let's talk about what they mean. And guys, this is a great lesson for you, because this one has actually been a termination condition twice, and twice it's reversed the market. And I love this, because this is a lesson. I try to equate ideas with like what's happening, almost like stories, right? So on this push down, the sellers were in control. And it's right at that exact number where the buyers came back and they stole their momentum, guys. So that pivot with divergence, if you think about it, a pivot with divergence is an exact line in the sand where the buyers stopped the sellers and stole their momentum. So that's, every time I see that, that's exactly what I think. And the same is true right here. This is the exact point where the sellers shut down the buyers 100%. And guys, look at this. The buyers didn't make it to the fib and the sellers tested. And then the buyers made it to the fib and the sellers unloaded. You're not the only people that know about these areas. But this line in the sand, the sellers tried again, and the buyers said, nope, we want it to go up. And that creates what we call a pivot stop out. They stop out every seller at the pivot, and that's what starts the move up. And when the sellers took back over, they made it to the exact line in the sand where the buyers told them, no, we don't want you to go below this point. And guys, these divergence lows are key. And there's one at 70.30. So if the buyers make it all the way up to 70.30, that's the line in the sand that the sellers created. And you guys can see these lines. You can see these fibs. And you can know exactly where decisions are most likely to be made. Pretty cool, right? What an advantage. What an advantage to have. I have momentum, but I don't have a clear path. The reversal bar printed. Let's go through a lesson. Price could return to these triggers. Price could return to these triggers. I have no idea which one it is. Price could also bounce off of these areas. And the only thing that I'm sure of right now is that my stop would have to go below these triggers. Is anybody comfortable with $200 of risk on a maybe trade? I'm not. So what can I do? I can force a confirmation bar off the area. If I feel like I want to take this trade, I can force a confirmation bar off the area. But look at this. I do have a strong bottom. And now I have divergence on a 50-50. There's a lot of stuff going sideways with this trade. Am I patient enough to not take it? And then for you 1 minute chart users, what does your 1 minute chart say? Your 1 minute chart says, hey, check it out. Those fast triggers are turning against me. It's likely to push lower. Let it. Just let it. All right, guys, what do you want to talk about? It's going to be a long day if you don't start getting chatty. Termination, termination, termination. Goodness. Did I mention that it's Thanksgiving on Thursday? Guys, give me something to talk about. Let's get some great lessons. I will have class tomorrow. Absolutely, Jerry. Man, Morgan, I'll give you the best lesson ever. Let me go back to the S&P. No, Belt. That's a holiday. I don't think there's going to be a class on Friday, Jonathan. I know you guys want to come in and sit in here and not ask questions, but we tend to take holidays off. Thanksgiving's a big one. All right. Morgan, I'm going to give you everything that you need right now, okay? Everything you need. No, you're good. If they're strong up, don't fight them down. If they're strong down, don't fight them up. It almost seems too simple, right, Morgan? Like, that doesn't even feel like that could be a real thing. But I kid you not, my friend. I kid you not. I'm not sure what that means, Rob. So Morgan, these are your fast triggers. You remember the lesson about as long as you're on the left side of these, it's going up. It's kind of the same thing. Just don't fight them. So, and let me take a picture. And I promise you, this seems too remedial, right? If I have a fib right here, and I'm thinking that I want to go short, wait till it gets to the other side. And if I'm thinking I want to go short, wait till it gets to the other side. And if I'm thinking that I absolutely have to go long, wait for it to get to the other side. And I know that that seems like just, Mark, you're dumbing it down. That's the easiest way to do it. So now you couple it, right? Is this says up, and I'm thinking about going up. Let me make sure that they're all there. Oh, that was the good old days, Rob. When he lived in the Woodlands, Texas, we would go through, he had a giant backyard, and we would build PVC goalposts. We'd build a 50-yard backyard football field, and we would line it out, hash marks, and then I would paint the Super Bowl team's logos in the end zones. It was always a good time. That was for the Super Bowl, though. That was, what, January usually? He would rent out a trailer with like 20 video games for all the kids. The Novak Super Bowl party was always one of the best parties. So Morgan, I hope that didn't feel like I was dumbing it down too much, but I promise you, that is the easiest way to get the most out of market flow. And then what happens is you begin to recognize things like where the HVA lines are on the bars and where the stranded sellers and the stranded buyers are. And you'll notice that as you use it in its most simple form. Like those are the next patterns that begin to present themselves. There's not a lot of poking to do, to be honest with you. And let me show you something real quick. You don't need them. But all it means, so anytime there's a stranded seller or a stranded buyer, let me find one. There's one right there. The market is pushing down. The sellers pushed all the way to the bottom of the range, but it closed up. Stranded sellers right at the bottom. Stranded buyers right at the top. That's it. That's the last point. They got stranded. They couldn't go any higher. So when it lines up at key Fibonacci areas and your triggers roll, it's a good stop placement. But if the triggers are strong against you, it doesn't mean anything. Not a lot of them, but there you go right there. So there's a stranded buyer just below the fib, right at the outer band, but there's odds favorable momentum up. Who cares? No, but it's just where the buyers got stuck. It's not magical. It's a 50-50 without divergence. That's it. I'm telling you, strong triggers, strong triggers, strong triggers. Who gives a shit if there was a stranded buyer? What do your rules say about the trade? If you have momentum on 3 charts from a strong bottom, does a stranded buyer outweigh a pullback to an area inside of favorable large triggers? So what happens, Morgan, is that's exactly what happens. Is people start saying things like, oh, I have a stranded buyer. Oh, there's a stranded seller. Oh, it's a white bar, so I've got to win, right? Dude, let it. Market flow is a confirmation chart. That's what it is. That should be the word that you use. Market flow is a confirmation chart. And no matter what market flow says, it doesn't negate that there's a divergence on a 50-50. Does that make sense? and you're on the wrong side of these that are turning against you, right? So how would I use it in this, Morgan? I would say let them push as far as they're going to push, hopefully down to 68. That's my point right there. They've got to push all the way down here. And then if I get back on the right side of these, like I did over here, maybe I'll take that trade. Has nothing to do with stranded buyers and sellers. And I think that's where people create challenges for themselves is the market flow chart is an accoutrement. It's a helper. It's a confirmation. There's everything you need to know about everything in it. But this warning is there for a reason. Do not stare. Seriously, do not stare at the market flow chart. Trying to figure it out unless your dynamic Renko bar charts are telling you to take a trade. That picture is in there for a reason, Morgan. And I know it frustrates you guys when I say you don't need it. So here's what I tell people to do. First, use it to confirm momentum. So when your Renko charts say momentum, confirm it with the range chart. When your Renko chart says take that trend trade, Morgan, go back and start studying what your market flow chart says right at that area. It usually takes people the longest, Morgan, because the second they add that chart, they abandon their rules on the other two charts. Does that make sense? As soon as they incorporate the market flow chart, they stop waiting for rules to be met on the large chart. And guys, the large chart still leads the way, even with a market flow chart. And thank you for bringing this up. There's a lot of things. It is pretty. The market flow chart is the siren song, guys. It is the devil in a blue dress. Because it'll talk you into bad decisions. Right? Morgan, I got an up bar. Is that a reversal bar? Shit, I should be long. And you ignore everything because you saw a green bar up. I'm telling you, I've done it. I've done it. When I got the market flow chart from John the first time, I think I took like 700 trades that day. All right, Wayne, everything says up. The market is screaming. There's nothing in the way. Momentum on every chart, and you jump in and ride momentum all the way up. And guys, notice that Wayne didn't jump in on the reversal bar on the wrong side of the triggers. He waited for it to get back up above the trouble, and it was easy money. Wayne, I love everything about that trade. And then weak bottom, odds favorable. There you go, Morgan. Everything says up, but it's not perfect. Wayne lets it get to the other side of those fast triggers. And it's easy money all the way up to the fib. There's a great example of it. His entry is 0975. His entry is above those fast triggers. There's Wayne, thank you. Morgan, send Wayne a nickel. That was it. But look at the large chart. So the large chart says momentum. The large chart has a pullback right to the large triggers. It corresponds on these split triggers. And Wayne says, let me get to the other side of my fast triggers. Does that make sense, Morgan? Cool. That's a good look. I'm not willing to fight him. And once I get to the right side of him, because my large chart said so, it made it pretty easy. Wayne, that's some great trading, dude. All right, M, first trade, high probability trend trade. All right, M, you ready? Beat you up here. Is it a clear path? There's three options every time you get to a fib. It's either a term, it's a 50-50, or it's a clear path. So a term means that none of the triggers are broken. A 50-50 means that the smalls are through but the large are not. And a clear path means that everything is below the fib. So what you have here, M, is a 50-50 look on that big blue fib. You had no divergence, strong triggers everywhere from a strong top, and you take the perfect entry at the lowest point of resistance inside of favorable large triggers. Your stop was in the right spot, and you got paid on the way down. This is a beautiful trade, M, but it's 50-50. And the only reason that I throw that out there, the only reason that I say 50-50 is because what it does is it gets you thinking, if for some reason I get divergence or a bounce off of that fib, I'm going to have to manage. Does that make sense? It's not because it's the wrong trade. It's because you have to put your management hat on when it's not a high probability trade. Beautiful. Great first high probability trade. That's actually medium probability, but great job. That's okay. If your brain's not working, it's okay to take a day off. All right, belt. Not a strong bottom, brother. That's a failed 50-50. Small triggers are through, large triggers are not. That is a failed 50-50, not a strong bottom. Does that make sense, Bill? Cool. Odds favorable, potential to break, no divergence, and then you've got two correction points. It could go from here, it could go from here. So you wait to get to the right side of the small triggers. Reversal bar, and it's a pretty easy trade up there. Nicely done, belt. On a 50-50 with no divergence, I'm usually in on the reversal bar. When these are split, that's my go-to right there. Nicely done. Z-Robot, you run into this often. Man, hold on. The cataracts are kicking in. At the fill line to do. What does that mean, at the fill line to do? Z-Robot, what are you asking me? Is it because it didn't fill? And you're wondering, what do I do when it hits it and doesn't fill? You can wait a second and see if it fills. Or you can hit sell market. But if you hit sell market and then it fills, you're going to be in twice the contracts. Does that make sense? Guys, there's going to be times where you get hit and not filled. It's frustrating too, and it's the perfect trade. But that happens. That happens every now and then. Or it just fills one. Because there's got to be somebody on the other side, guys. There's got to be someone on the other side of your trade. So sometimes I've had it happen. The worst is when it hits your profit target and then rockets the other way at like 10,000 miles an hour. And you're like, son of a gun. But if I get hit and it starts down and it didn't fill, I'll hit sell market and I'll cancel that order. Because that's where I wanted to be in. Good question. I hope that was an okay answer for you. And then Kurt. At entry, it was 50-50. Where was your entry? 58? Okay. So what did you use for entry? Entry when white paint bar closed above 8 threes. Man, I have to believe, Kurt, that is a falsehood. because your white bar was at 1035 and your entry is all the way over here. Do you see it? I don't think your entry was when the white bar closed above. Okay, so what's the key for the up-down, Kurt? And welcome to people messing up news lessons. I love it. What's the key to the up-down? Let's take a look real quick and let's turn that into a lesson. Dun, dun, dun. Look at that 1 minute bar. No, there is and it's different, guys. It's different on the range chart. But the biggest thing, no, for just that up down pattern, guys, odds favorable momentum. Odds favorable momentum is the key on that down up pattern. Everything says up bar, that's your entry. Everything says down bar, that's your entry. But if you guys are using this 1 minute chart, it doesn't work. It's not the same. It's not the same. So let me build a range chart. Where's it at? There it is. Give me just a second. I want to show you what it should look like, and talk about the advantage that this look gives you. So it's coming up right now, and we're going to put these range charts side by side. So this is your 1 minute. This is the one everybody is all aroused about from John Novak. Depends on the market, Gary. But I want you to see something. So Kurt, this is a good one. This is awesome. For you guys using that up-down pattern, whether it's for management or entries, Kurt, that's your pattern. And it sets up freaking amazing on an 8 range. And at that same point, this is what it looked like on the 1 minute. Because the range bars are all the same size, what it does for you, Kurt, is when you get that down bar with odds favorable momentum, is it gives you this box. And I love it because it gives you a box around this. And that box starts, let me move it. I'm going to show you. Make it big enough to see. So the box, what happens, come on, grab hold of it, is it starts about right here. And on that down up pattern, Kurt, when you get that down bar, you can buy it. I'm going to buy this market once I get the down bar. And at the bottom of this box, that's where your stop goes. And it's like, man, it's like 8 ticks, maybe, because all it is a momentum trade. And then as this bar forms up, the box comes up with it, and your stop literally follows behind that box. And by the time you get that up bar, your stop is 2 ticks behind it. So guys, that up-down pattern is freaking rad on an 8 range. Look at the size of that bar on the minute bar. Do you see how it kind of pulls away some of the goodness? And this is one of the things that happens is you get a new tool and you get excited about it and then we misuse it. And that's okay because we can fix anything. So if you're using that up-down pattern, rock it on the 8 range. It'll help. It'll help. I guess I'm just going to keep building range charts too. And then let's just go back and look at yours real quick. So you didn't have the momentum. And because it's that 1 minute, it's a little different. Actually, is this a 1 minute or is this looks like a range chart. Looks like an 8 range. This is a 1 minute? Oh, it is. There it is. I just don't really see an entry there. No worries. But good lesson on where to use that up down. All right, M. All right, M. This is where you learn that I see everything. Are you ready? You did not exit on divergence. You're full of beans, my love. Because divergence wasn't true until the third bar up. You exited because of a $200 profit target, not because of divergence. There is a, okay, well then you posted the same picture. You posted the same picture twice. There's your first trade. I don't see a second trade. Oh, you didn't exit the trade, you canceled the trade. Divergence printed, you canceled the trade. I got you. Never mind. I'm with you. Little lingo there. G'day. That's all right. Lingo. I don't speak Australian. Yeah, so you canceled the trade. That makes more sense. I like that. 50-50. Divergence prints, you chose not to take it. I dig it. No, that's great. Sometimes it's me. Sometimes it's me that doesn't keep up. That was all on me. Great job following the plan. Jonathan, look at the abandoned buyers as the market keeps going up, not down. There you go. Thank you for that, Jonathan. Exhibit A, right? Everything says up, and those stranded buyers weren't enough to magically make it go down. What a great lesson. Thanks for that, dude. What a good picture. Morgan, and that kind of goes on to it. Like, there's a time to use them. I haven't found it. Actually, that's not true. I can use it every now and then. And at 1050, there's Wayne's pattern. Termination condition, white bar down, maybe take a shot. So, that's an awesome picture. And you have to see that a few times, right? Because in the beginning, you get excited about them. In the beginning, you get super stoked. And check it out, 50-50 with divergence. No reason to ever take that trade. No matter what your range chart said. No reason to ever take that trade. Does that make sense, guys? And then your 1 minute range chart, let me see, right at 65. Your 1 minute range chart tried to talk you into it. Hey, look, there's your close. Look, there's my white bar. There's a close above. I have to go long on the 50-50 with divergence, and you just get run over. Completely run over. Isn't that awesome? I love it. Love it, love it, love it. And guys, I'm the most guilty party in the world about abusing the market flow. Well, I had an HVA line, so I went short against strong triggers. I had an HVA line, I went long against strong triggers. I saw a white bar in the middle of nowhere. That had to be a trade, so I just jumped in. And so make sure that you're following rules a little bit. Make sure that you're good. It'll pay dividends. It really will. All right, guys, I'm going to take another break. You only take the entries on the HVA line if the triggers are split in the direction of the trade. So similar rules. I like it. So you're using it for confirmation, right? I'm thinking about taking a long. I've had like 50 pictures up. What was it about, Jonathan? I'll find it. I just want to make sure that I'm posting the right one. Here, hold on. Was it a picture that I took? Is that it right there? The up-down look? Cool. That was easy, wasn't it? There you go, bud. Oh, hold on. That didn't do it. That was just my arrow. Let's try that again. That's a much better picture. Awesome. And man, I love this look. Guys, if I'm in a long trade and there's nothing in my way to my targets on my Renko charts and I have momentum, I'll use this for stop placement. Like if I'm long from down here, when I get that down up, there's my stop. And then I get that down up and there's my stop. And I get that down up and there's my stop. And I'll use this to reduce risk. And let's say that I'm going to try it here too. That second down bar pulls me out, which is pretty cool. All right, guys, I'm going to go stretch my legs. I'll be back in about 5. Post them if you got them. Last hour here. And let's see what happens. Crude oil doing its thing. S&P was directly into a termination condition. Here we go, Morgan. John sent me this in Skype. So he's looking for a short on the overall trend. And once he gets back below the stranded buyers, he's in for another shot. So He's using it. But why not that one? Why not that one? Why, you know? It just doesn't give you any insight, guys. This is an incomplete thought. So I'm just showing that he is using it. Notice that he didn't go long on stranded sellers. Or this stranded buyer, that stranded buyer, that stranded buyer, that. So there's more to it. Just saying, there's more to it. All right, Wayne. Whoops, hold on. My refrigerator's open. I'll be right back. I hear it dinging. Sorry, guys. New house. I'm learning the new appliances. And Jonathan, that's it, man. Large charts must agree. And that's where the advantage of market flow comes in, is it gives you a look. It gives you a look when the large charts say it's time to go. So, all right, Wayne, momentum, weak bottom, 50-50. Not a 50-50. Mid-band's only a termination condition if large triggers are a full bar away. But that weak bottom makes it more likely to bounce. You jump in on the momentum. When momentum fails, you choose to hold and you take the pull back to the mid-band. And then it goes up, you get paid, and then divergence, and it bounces, and you make another 180. Nice job. Nice job, Wayne. Everything says up strong, and you went up with it. What a great lesson. Everything says up strong, and you go up with it. Guys, the S&P is a mess. All my triggers below resistance, all my triggers above support. Synthetics are up, large are down. Yeah. Hold on. Oh yeah, we're 2 days away from Thanksgiving. Guys, tomorrow's going to be more of the same. I had my buddy, he's like, hey, market's going to be open on Thanksgiving till 1:30. I was like, dude, go eat turkey. The people that do this for a living, guys, they're at home with the people they love. They're out doing stuff. Let's see what a market analyzer looks like. It's still up there. It's still up there. We've still got good volume. There's just a fight, guys. Fights happen. I mean, look at that. They're just trying to work it out. Doing this for a living? Well, the difference, Rob, is the people that really do it for a living have a plan. They know why they'll enter and exit, and they stick to it religiously. So we're on our way. We are working on being able to do this for a living. We're learning how. We're teaching ourselves what it takes to be successful. Some of them learn by doing. A lot of people do. I think one of the things, though, Belt, is if you do it wrong, what are you learning? How do you know if you're doing it wrong? Self-taught is tough. It's amazing how much faster you get to where you want to be with a coach or a mentor or somebody on the outside looking in. It's back now? Right on. I think the hardest thing to do is nothing. The hardest thing to do is nothing. Fifty-50 split triggers. So how do you read this, Morgan? The fast triggers are above the large triggers. There's an HVA, but the fast triggers are down. You had divergence, but we're into support. Is that an up look or a down look? And then we go to this chart, and we're like, well, that's momentum down with the potential to break. It's weird. Well, the 1 minute, the smalls are below the large. Hold on, nope, that's not updated. If you were looking for the short on the 1 minute, if your large chart said down, somewhere right here was your short. Once you get to the correct side of the fast triggers. This said down from a failed 50-50. This said down potentially from an area, but they're split. And then where's that last one? And this one told you to just pump the brakes and wait to get to the right side of everything. Does that make sense? So it's a top-down look. Start large and see what happens. Garbage. What do you guys want to talk about? Tomorrow may be a short day, guys. If the market's not doing anything, it may be a shorter day. So today's a great opportunity to say, hey, Mark, let's talk about this. And Morgan's like, I did that with market flow, and he told me to not let it lead the way. I don't always give the answer you want. But I promise you, market flow, first commit to being on the right side of those fast triggers, Morgan. And it's kind of like when you learn the high probability trend trade, you start to see the other trades. It's very much like that. When you let that don't fight become the foundation, there's more opportunities out there. More opportunities. Lots of opportunities. But I think if you're going to use that up-down pattern, definitely 8 range is more valuable than the 1 minute. I don't know that 1 minute is more valuable than the 8 range on stuff like the S&P and crude oil. I'm not sure. I haven't done any research on it. My brother uses it for the NASDAQ. Trying to go where to figure out where to go next. So, all right. Let me go back to crude. And let me turn this into a 3-chart scenario. And we're going to come off the termination condition here at 27, Morgan. And let's just look. That's okay. That's how you get to where you want to be, is you just go in and practice. The challenge is that people try it live. People say, oh, okay, let me go live and try to incorporate this new trade. Let me go live and try to incorporate this new look. 69.27. So where was that low? All right, so there was your low, Morgan. There was your termination. And that's where it came. So your white bar in the triggers roll gets you looking, but there really wasn't an opportunity there. So let's go to the next termination condition. Let's go to the one up top at 944. Termination, termination. Probably right about here. So Morgan, let me give you a video to watch. So watch this while you're on Thanksgiving break. And maybe you've already seen it. Maybe you haven't. I'll just go to YouTube. This is John talking about the white bar trade. So the trend trade you're good at, right? The trend trade you've got. You know the trend trade. You've got your rules for the 50-50 and the trend trade. So now, Morgan, your next trade is finding a way to get in closer to a top or bottom. That's the next trade. Nexgen teaches the HVA trade, which means that a termination holds, triggers roll, and sell the HVA from a top, buy the HVA from a bottom. So that's like the second trade for most people. You get your top, sell the HVA, it didn't give it to you. Let's see if there was a bottom in there. At 940 there was. So you get your termination, whoops. You mess up your charts. $69.20. That was it right here. That was that big one bar. It didn't happen. So the white bar trade and I'm trying to find a good example of it here. 805. Let me get to 805. Right here. Let me get to 805. I'm trying to find an HVA trade. There hasn't been one. There we go. So check it out, Morgan. Termination. 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 And then when the fast triggers roll, Kurt, the fast triggers have to roll. So the white bar is your first potential entry. But look how it pulls right back to the HVA and then it just drops. So this is your HVA trade. And that was 820 where that finally set up. Let me see what the price was, 58. So that rolled. I'm having trouble lining it up here. Oh, it's because it's a 1 minute. Let me look at it. I don't know that the 1 minute's your right chart for the HVA trade. Let me look at the one that was designed to go with it. And let's see if that's a little cleaner. See, I don't think that the 1 minute is the right version for a lot of you guys. I think it's just fun because John Novak said. Termination was at 8:05. So there it is. Triggers roll. And let me get back to 8:05. There it is. So there's that white bar. Termination, termination, white bar off of it. Sell the pullback to the small triggers and go. They never made the HVA trade. We'll see what the current market is doing. Now you've got 50-50, odds favorable. You've got, that was your trade with the split triggers. Wait for confirmation. And now you've got an HVA line that lines up right with a mid-band inside the triggers on a 50-50. And that's all it is, Morgan, is it's pretty much it's a little more specific. So like with this look on all of them, if your one up, one down pattern would literally be that much risk. And you've got a mid-band, you've got an HVA, you've got odds favorable. You'd get in just below, and every time this ticks down, your risk goes down. It doesn't guarantee a win, but notice up, down with odds favorable. It only stopped one out. Oh, that's weird. So you can take stuff like that. And then when your up-down fails, there's your up, there's your down. It's a tiny little loser when it fails. As opposed to a 1 minute, which may give you a huge loser because it may get like 4 bars. It hasn't reached it, belt. Price has to reach an area. And price didn't reach that divergence. That's it. Price not smalls. So if you tried the momentum trade, it didn't work. And now, Morgan, do you see how these are up against you fast? That should be enough to go, whoa, I'm not just going to jump in at the mid-band. Make sense? It takes a while. We'll keep talking through it every day. But start taking pictures and posting them for me. Pete failed 50-50. Everything rolls. Momentum is there. It's a 50-50 trade. No divergence. Because it was split, you wait for confirmation. And you get a better entry on the half point of the bar, which I really like, Pete. And you take it right down to trouble. Great job, dude. Great trade. Great patience on that entry. You knew it was going to go down if it was going down. I like it. All right, guys, what are we going to talk about? Mess and pee. We're losing people in the room. That's okay. It's the holiday. Everybody have Thanksgiving plans? I guess you guys overseas, maybe not. Prime rib, I like it. 10 grand on the big account. That's not so bad, Pete. Yeah, me too. We have everything. I'm stoked. I've got my kids now. Now that I'm here, my kids are 20 minutes away. So I get to cook for my boys. I'm about to break into the ham. Weak triggers at a divergence high. That is not a 50-50 look. Takes momentum on a 50-50 look. I wish they would have eaten nachos. I'm on a keto diet. I'm not gonna lie. I'm so sick of steak. I never thought I would say that in my life. Huge party in your garage with a class of 88. Hair Nation all day. I love it. There we go. Since no one's asking questions, why don't I go ahead and brag a little bit? That's the view off my back porch at sunset. They didn't land in Houston. Honey glazed ham, garlic mashed potatoes. Stuffing, green bean casserole, all the good stuff. Let's put on some weight. That's not bad. I love being in the hills. There are a herd of deer behind us. I see deer all day long. My poor dog doesn't know what to think. And no snow. It was 39 this morning. I had to actually wear a hat. There is no road, Rob. It just stops. There's about 30 acres behind me, undeveloped. And they know one day they're going to develop it, so the road stops right there. And it's all trails, surrounded by parks and stuff. Yeah, that's where the road stops. Here we go. Let's see. The fast triggers are still up. We'll see if it pushes up higher. It may not. Guys, what do you want to talk about? We're seeing it if it gives you a lesson, Morgan. Just the fast triggers are still up. Do you see it? And look what it did. So there's another way you can use the market flow chart. Don't fight them. It might still go down. Let it slow. Man, this new house. If your rules are met, Rob, for sure. It might. Now I've got odds favorable. I do have a clear path. I haven't reached the next area, and it just pulled back to the mid band. But there's areas higher too. If you had a confirmation bar, you're still kind of in that limbo right now. If you took the trade and your new stop was right here, second higher divergence, still have areas inside of triggers. Does it fit the rules for the high probability trend trade? Odds favorable, clear path, pull back to resistance. Where does my stop have to go? Well, it would have been up here, but now that I have a reversal bar, stops in place. Do you see it? Odds favorable, clear path, pulled back to resistance. I'm in low though. And Morgan, look what happened on your range chart. The fast triggers did roll over. Doesn't mean it's going to win. But are your rules met? That's all you can ask. Are your rules met? Mine would be. With momentum, with all the triggers below resistance. Well, with the second higher divergence, my rules, Jonathan, say I can enter with a reversal bar after a second higher divergence. That's exactly what I got. Because my large chart leads the way. Does that make sense? My large chart says down with momentum. The second higher divergence let me know that it may push up here. And then once it starts back down, easy peasy. Does that make sense, Jonathan? Not a deal breaker, just a heads upper. And then now if I get a third divergence, that's the deal breaker. But look what the large chart says. Large chart says down. Large chart says there's nothing in the way. I have a $100 target. If a third divergence prints, I'll exit. That's the only reason to exit. But what's changed since my entry? Now I'm on the good side of the small triggers. Right? They're pinching and rolling and starting to head down. Uh-oh. Is it going to print a third divergence? I don't know. It went where the indicator said it would. And if you're looking at your range chart, all your triggers are pointed down on the range chart for now. I think the weird thing is a lot of times when you enter a trade, you forget that you're not in control. I've already got 2 divergences, so 3 divergences would be a deal breaker. 3 divergences will be true right there at 45. I'll know whether or not divergence is true by 45. So I've got even less risk. I've got 6 ticks of risk on this. If the divergence becomes true, if that cyan line prints, I'll exit. If it doesn't print, I won't. So I'll just keep my finger on the close button and we'll wait and see what happens. My stop 2 ticks above the reversal bar marker means that if it happens so fast I can't react, I have a little safety net there. You stayed out. Why did you stay out? That would be the question. Which one of your rules wasn't met? That's what I always tell people to ask themselves. If you skip a trade, why? Was it because the rules weren't met? Was it because something scared you? Okay, so where in your rules does it say green triggers are a killer? And let me show you something cool, Jonathan. I'm going to go through that favorite look section, or the client trades. So this is a trend trade long, and the small triggers turned against it. And trend trade short, small triggers turned against it. Trend trade short, small triggers turned against it. Do you see where I'm going with this? Trend trade long, small triggers turned against it. So one of the things that we do is we begin to fabricate rules that make us feel safe. Guys, there's a reason that I don't discuss the trigger lines on the small chart for the high probability trend trade. Because look at the trigger lines on your large chart, Jonathan. Remember when we talked about the large chart has to lead the way? That's why. Because this one will scare you out of stuff. Remember how if you're in a long trade and you get a close on the wrong side of the small triggers, isn't that kind of a killer for the up movement, Jonathan? Remember that, guys? We talk about that lesson. If I close below those small triggers, it's probably not still going up, at least in the moment. And that's kind of where it started going down. I love it, guys. All of these little lessons that you get, they begin to compound. And the more you study them and look at them and practice them, then the quicker you begin to piece them together as the whole. So if I'm managing this trade, my large chart, there's nothing on the large chart scary. The only thing that I have even potentially against me on the small chart is the potential for divergence. But if that potential for divergence doesn't happen, let's talk about it. I have the momentum, I have the clear path, I'm coming right off the area inside of favorable large triggers. Now my small triggers are down, and I'm on the good side of them. I can't find anything wrong with this trade. And my stop is right where it'll help me get out if that divergence is true. Does that make sense, everybody? And the reality is you could have been in at the mid band. I was in late because I waited for the confirmation bar. And we were talking. So here's that magic phrase. What's changed? Since entry, what's changed? No divergences of print. We're on the good side of the small triggers. The bounces happened. I can't find anything negative that's changed. None of my advantages have gone away. The only way one of my advantages are going to go away is if divergence is true, at which point I'll just exit the trade. If that doesn't happen, guys, I'm committed. I'm in this one for the long haul. We are married with kids, and we took out a mortgage on a double wide. I just have to let it play out. And the longer it takes, the more likely you are to create opinions. I will. If divergence is true, I'll just hit close. My advantage is gone if I get 3 divergences in the same price range. They're messing with us, aren't they? How long are they going to sit in this range? Has anyone just said, oh, it's taking too long, I'm going to exit only to have it run? I have. Not proud of it, but I definitely have. Uh-oh, it's going down. Aren't we glad that we didn't just jump out arbitrarily, nonsensically? That's all right. I can read poor writing. I'm that guy when you see it written backwards or upside down, I can still read it. So there's just nothing to do at this point, right? It either hits our first target or it doesn't. But that's why we don't exit on the potential of divergence. And now what? Now the small triggers are down even more. I love that. That divergence low represents my trouble spot, right? So if something happens there, I might have to change my plan. Is all this making sense to you guys? I hope so. One of my favorite things is like, when I'm in this trade, I'm just like, It either does or it doesn't. It either goes or it doesn't. It either wins or it loses. It doesn't matter. When I have odds favorable momentum and a pullback to an area inside of favorable large triggers and there's nothing in the way, 7 or 8 of these out of every 10 I'm probably going to win. I don't know if this is going to be one of them. Love to hit that first target, right? 7 days later. We've been in this for almost 10 minutes now. Almost 10 minutes now. Hoo-wee. Oh no, and now they're going to come back and stop us out. Bunch of jerks. Oh no, wait, now we're going to win. Nope, we're going to lose. Oh, now we're losing. No, now we're break even. Man, it's an emotional roller coaster. We're break even again. Oh no, we're winning again. Nope, we're losing. Damn it. Arg. Anyone else ever done that? Oh, we're winning again. I don't know what's going to happen. This can drive you nuts, though. Be right back. 30 seconds. Did it get us yet? Oh, look at that. We're winning again. Man. Whew. Somebody pass me the Tums. Jonathan, I know this kills you. Just take the money, Mark. Just take the money. My money is at 69.29. Anything before 69.29 is not my money. It's kind of fun though. Does this help watching it live, talking through it? Look at that. Now my small triggers are down and they're starting to get wider. That makes me feel good. Notice how the large chart hasn't changed? It's still odds favorable with a clear path. You ended up at 40. Remember guys, I don't tell you to take trades. If the rules are met, I take them and talk through them. Me entering a trade on simulator is never telling you to take a trade. It's important that you understand that. But I'll talk through it because it's pretty common. You're going to see this look. They're trying, right? There is a fight going on. There is a definite fight going on. When it pops, I bet it pops big. We'll do 2 lessons. We'll take the first profits at 100, and then I'm going to put the second target low, and on the second contract, assuming we hit the first contract, we'll take a close on the wrong side of the triggers. We'll see. It may never get to that point. You guys going to be here tomorrow, or are you cooking tomorrow? Why would your target be on the wrong side of that big ugly divergence line? You remember that, right? I mean, you can see what it's capable of right there. Brian tomorrow? It's funny how many men cook Thanksgiving. When I was a kid, it was aunts and mom and grandmother, and now all of my friends, all my guy friends, we all cook. We cook more than our wives do. I like it. I would rather cook. Oh, you're welcome, Em. Good job. I hope you feel better. It's no fun to feel bad. They're messing with us, aren't they? Oh, they're so close. I know you do, Jonathan. It's because you don't have a written plan. Can you imagine if you actually wrote down exit conditions? Nice, Gary. I like it. I prefer 2 lots personally, especially on sim, because you can focus on stop placement, you can focus on management, but you also leave that door open. Once you get paid, I think management's easier, right? Make $100, and then once that $100 is in the bank, it's easier to hold for that bigger move if that bigger move's available. All right. I like it. There we go. First target hit. I'm break even. All right, guys. We're going to hold this one until a close on the wrong side of the triggers. Ooh, look at that. Fib update. Can't lose. That would be such a good exit, wouldn't it? So now here's the next lesson, guys. As long as it doesn't close on the wrong side of those small triggers, it's probably going down. And you guys that panicked up in the beginning, it never closed above them. Pretty cool, right? Patience is rewarded. And every time it goes down, so does my stop. I'm just locking it in. This is a great way to, if you're like, man, with that momentum, this area has the potential to break, I'll chase that reversal bar marker. I'll force them to take me out. Otherwise, I'll just take the runner. And guys, that's going to be it for me today. Got some good lessons in there. Do me a favor tonight. think about, what do I want to talk about tomorrow? Don't be afraid to, that's enough on that one. It's simulator. Don't be afraid to come in and ask different questions, guys. I would love to help you out. Go enjoy your afternoon. I will post